Wouldn't it be awesome if us as investors can predict when a recession is coming before it's actually here? Hi everybody, this is Elisa Zhang. In today's video, we're going to talk about a simple chart called a yield curve that can predict a recession that is coming in the next 19 months. To understand yield curve, we have to start with US Treasury securities. When you invest in US Treasury securities, you are lending money to the government, federal government specifically. In return of your fund, the government is paying you an interest, very much like a bank. The Treasury market is an open market. Like anything that is open, it's driven mostly by supply and demand. When more people want certain kind of treasury bond or bill, the price will be bidded up and the profit from the security investment will get smaller. We call that a profit yield. Also simply put, a yield is equivalent to an interest rate. Though all rates correlate, they don't always move in the same step. Short-term rate may fall, while long-term rate might rise, and vice versa. Let me first explain what is considered short-term and long-term treasury. A short-term treasury is anywhere between 6 months to 3 years or less. But in normal yield curve chart that most people are interested in looking at, we use 2-year treasury yield. What is a long-term treasury is any investment that is more than 10 years. Normally, long-term investment typically yields a higher yield for investor than a short-term investment. Imagine going to a bank and facing the choice of investing long-term for 4% interest rate versus short-term for 2%. Typically, you have to decide whether you're choosing liquidity or for a better interest rate return. Simply put, you have to decide between locking your money in for 10 years and getting a 4% rate, or have the flexibility of accessing that money in 2 years and put it into another investment after 2 years. Of course, if you think the economy is going to go great in 2 years, you might choose the short term because you may think that after 2 years, there'll be more opportunities to make a better return. Therefore, you choose to put your money in the short-term treasury. Now, let's take a look at yield curve. What is a yield curve? A yield curve is a line that plots yield, interest rate, of US Treasury security that have equal credit quality but different maturity date. The slope of the yield curve gives an idea of future interest rate changes and economic activities. As you can see in the vertical axis, this represents the yield, which is interest rate, of the product that you're investing in and what it generates. Now, that is a normal yield curve. Most time in the history, the yield curve look like somewhat like that. If you like what you're learning so far, please take a moment to subscribe to our channel and like this video to help us out. An inverted curve, aka a negative yield curve, means that a short-term US Treasury is paying a higher interest rate than a long-term US Treasury. In this case, the 2-year Treasury is now earning you a higher interest rate than a 10-year Treasury. The inverted curve was first coined as a recession indicator by financial economist Campbell Harvey of Duke University in 1986. Here's some historic graph on inverted yield curve, and you can see they pretty much lead all the recessions as a great indicator. So we're putting our thinking hat on. Why would an inverted curve be a leading indicator to forecast recession that is coming? Why would someone choose to invest into a 10-year investment for a lower interest rate versus something that will yield them a higher interest rate for a short period of time of 2 years? When they do that, this means that they have no confidence in the future of the market. In 2 years, when they come out of their current investment, there may be fewer opportunity, or they believe there is a fewer opportunity for them to make a better investment. The 10-year Treasury at a lower interest rate may give them a better chance and better yield over the span of 10 years. Thus, they would rather buy a 10-year Treasury at a 1% rate versus risking their money and park their money in a Treasury that yields 2% but only giving them security for 2 years. Here is where the yield curve is right now. Take a look at this graphic. What do you think we're in right now? We're in a negative yield curve zone. It is super important during this time to vet the investment you're making to avoid catching a falling knife. Check out our video on how to evaluate real estate, particularly a permanent investment during this turbulence time, so that your money can work harder for you so you don't have to.